Hello, everyone, and we hope that you are doing well. Now, we would like to welcome you into a Younium webinar on the topic of key metrics for 2023. My name is Hervoy, and I'm a demand generation manager. And along with me, I have Wolter, who is our subject matter here in Younium, and especially subject matter for this topic on the metrics. Also, Wolter is our main presenter, and I can say that this is our sixth webinar that we are doing together, Wolter. You know what? We have over 140 submissions for it. So it also shows us how important this topic is, and that everyone else are seeing very, very important the topic of the metrics, especially when now we are entering the 2023 with all of the uncertainties, and the metrics can and will, I'm sure, play a key role. We are really glad that you are all seeing this as an important topic and that you also took the time to join us. For those of you who are watching on demand, thank you so much for your interest. As mentioned, we see this and we see the metrics as a very important and topic for several reasons. In one of our previous webinars, what we had about the venture capital company from Netherlands, Younium, we heard that the VCs are not slowing down the funding, but they are actually looking how well the companies are prepared. And what we also know from the what will happen, or like prognosis on 2023, we know that the finance teams are going to play even more important role on the decision-making table in 2023. So this is why the metrics are very important, and we are super happy that we are able to share you a couple of insights what we have here at Younium. Also, we would like to thank to everyone who sent us their questions, that we will look and that we deep dive into those metrics, and we will explore them more during this webinar. Okay, I think that I took a bit longer intro, as always, Wolter. This is now the sixth time, and I think that you know that I do these intros kind of long. But let us go into a few housekeeping points of today's webinar. So we have 50 minutes for it. We are recording it as well, so we will send you the recording in a couple of days. But also we are going to send you the presentation, and we are going to send you a small gift, one guidebook what Linda prepared for us. In the introduction, Wolter is the main presenter. Linda is our let's say behind the scenes, so running the show behind the scenes, and also she will monitor the chat. The chat is very important for us today. Please send us your questions. We will have two Q&As during this webinar, one in the middle of the webinar and one at the end of the webinar. So yeah, please drop us also your questions, and let us be engaged as much as possible to have also good discussion and to learn something new. That's it. I don't know, Linda, would you maybe like to say hi to the audience?
Hi, everyone. I'm looking forward to share your questions with Wolter and Hervoy. Have a nice time.
Thank you so much. And yeah, Wolter, the floor is yours.
Yeah, thanks. Yeah, nice, Hervoy, nice six webinars together, and cheers to many more. Today, we asked, actually, like Hervoy also said, many of you, what would be of interest to you? What are metrics that are keeping you busy? What are things? And we got some super nice answers from the audience today, actually. So we try to emphasize this webinar a lot on that and combine that with what we think is the smart things to look at for next year. So yeah, I think everyone will have something interesting. But like Hervoy said, for those little metrics that you were hoping to see today and that maybe not would be included, we get you a little gift at the end to make sure you still have what you came for. So we're going to talk a bit about, you know, what changed in SaaSland. Why do we specifically talk about new metrics for next year? We're going to zoom in on valuation of companies and the capital efficiency of companies a bit to make sure that we, that you know what's going on there. We talk about the roadmap and market performance. What metrics do you need to look at to determine how that's going, and are you investing in the right places? And yeah, that's quite important going into next year. We also talk a bit about the upsell opportunities that not every SaaS company is grasping very well. And then if you do, what do you need to look at to see if it's working, right? And the last, and certainly not least, is the North Star metric, which we would be super curious to hear about, like who of you has something like this already. And we will leave you, like Hervoy said, with your gift book, your SaaS metric guides book in chat at the end of the webinar. So without further ado, of course, and we have the Q&A at the end, but we also have one directly after the valuation and capital efficiency topic for the interim question. So feel free, as soon as something pops up, to jump, throw it in chat, and then Linda make sure that it reaches Hervoy and me. So that should be good. So I'm going to depress you all right at the start of the webinar. So I'm sure quite a few have and signed up for this webinar because you know the times are a bit harder. I mean, there's inflation, there's valuation discussions, and there's just in general a lot of uncertainty in the economy, which yeah, I think it is a common topic in SaaS, but in many other businesses. And I think what was kind of the trend, roughly, don't get me on these dates here, but roughly before April this year, was kind of this. You know, this was what SaaS companies did. Like, here's my money, just grow. And it's like VCs were just like, yeah, just spend it. We'll see how it lands. And we kind of see, you know, that's slowing down a lot, actually. So, you know, it's much more about, you know, how are you efficient and how do you actually spend the money? So you had that 10 years ago when in the Netherlands, at least where I live, like when you want a mortgage for your house, you go to a bank and say, hey, dear bank, this is my salary slip. Can I get a house, please? And they give you the keys and you move on with your life. And that's it's not exactly, of course, true, and it's also not exactly the same with funding, but it was kind of the same principle. And now it's, you know, we need a bit more figures to look into. So if you go for mortgage now, you need to maybe send in more than just your salary slip, right? Moving on, so what matters according to venture capital? So there was this research, and for those that joined our webinar 3 months back with Younium, they may recognize this picture actually. But this is also very interesting if you don't speak to investors, if you're a bootstrapped company, because you can imagine an investor deals with maybe 40 companies. So it's extra important for them to pay close attention to these things, right? So you see that valuation and capital efficiency are kind of the game-changing things we should focus on this year and going into next, of course, more than the previous years where it was more about the teams, the organization, how fast is your revenue growing, what is your market potential, and things like that. So now we also talk a bit more about, you know, how are you spending the money? And how do you learn how you spend your money? It's this. Metrics are your business mirror. So, you know, they tell you, like, did you do any new deals? Did you have any upsells? Are customers going anywhere? How is your roadmap performing? Which markets, which segments are doing quite well? Where can I, you know, grab more money? Where can I grab more momentum? Do I have opportunities? And what cash do I have to spend it all on, right? So this is super crucial to look at metrics in general. But I think you know that because otherwise you wouldn't be here today. But just make sure you understand this. Metrics is not just, you know, in the good old days, it was like we reported at the end of the month, like, here you go, dear CFO, this is what we did the previous month. Like in terms of revenue, it was very reactive. And now we really use metrics to be proactive and decide next steps and learn from these things. So it's super important. So if we pick this capital efficiency and valuation as our main categories, there are a bunch of metrics that define how good these are and how, yeah, they're kind of directly related as well. So in capital efficiency, it all comes down to how you're spending your money and what do you get in return, pretty much. So grab your notebook, but like I said, this is going to be recorded because we're going to do a bit of a metric speed run. I don't know if that's a thing. Now it is. And dash through a few of the things you see here on the flywheel. So like I said, you also get the KPI metrics guidebook later in this webinar, so you will have a bit more explanation on this, but you know, we're going to run through it quickly here. So the first is actually the burn multiple. It basically takes the money spent over a time period, which is typically a quarter divided by the ARR. So as an example, a company spent 2 million euros and got 1 million euros of new ARR. That means you have a burn multiple of 2 times, which is not a great score if you're a startup. Under 1 is really good, over 3 is bad. That's how this roughly works. Like I said, I don't have to remember it in detail, but it's a very important one to see how are you cash efficient, right? The CLTV to CAC ratio is one of the requested metrics for today as well, is measuring the lifetime value of a customer. So the revenue that brings and measures that against, so the revenue you get from a customer, you measure that versus the cost you made to bring that customer in. So it's kind of a profitability metric, if you will. So if the revenue you get from a customer, the lifetime value is roughly 3 times that of an investment, you can say you're a profitable company. That's a good metric to look at. It's a rule of thumb. So, I mean, if you're very high on the cost, maybe it's not 3, you need 5. But typically, if you have a ratio of 3, you're a profitable company. The efficiency score is almost the same as the burn multiple, which we just covered, but it flips the numerator and denominator. That's before the webinar, I practiced how to say this fast 10 times, as it takes the net new ARR and divide it by the net burn. So it's a similar principle, but just looking from a different perspective as the burn multiple. You have the rule of 40, and that measures the revenue growth rate and the EBITDA growth rate in a percentage. And those two combined should meet or exceed 40%. So if your margin grows by 20% and your revenue grows by 20%, that totals 40. So that's good. And typically startup company, they don't really focus a lot on the EBITDA side, on the profitability side, they focus more on the revenue. So it could be so they have, for instance, 35% revenue growth, but only 5% EBITDA. But then if you stick to that 40, it's still good, right? So you just need to make sure that that's a healthy way of living in SaaS. So that's an important metric to start looking at. The SaaS magic number is on here as well, but we have some dedicated slide on that because that was kind of the most common requested metric from our audience going into this webinar today. And again, big thank you for sending that in. Then we talk a bit about valuation, and talking about valuation is always a bit tricky because you have, a lot of things to focus on and a lot of interpretations on valuation. So it's really hard to talk about like in a general way. I think for those who don't know, you have the EPEF method that determines the valuation, which is most commonly used by many investors and like bigger corporates. And I think if you just learn a bit about that, I will not spend any time on that on this webinar because then we need 5 extra hours. It's a big document. But then, going into a conversation with a VC or with, Visma wants to buy you or whoever wants to buy you, then you have kind of a standardized way of evaluating your business. So it's extra tricky to go with that. You saw last year's pretty much like in the house market, the house market, again, to use the houses, it skyrocketed, right? And the same happened with SaaS companies. There were multiple multipliers out there that were kind of ridiculous, to be completely honest. And I think that's the same with the house prices, right? I mean, a starter can almost not buy a house anymore. And I think this is kind of happening to SaaS now that it brings it back to a respectable and discussable level. So it sucks for the SaaS founders a bit that the valuation goes down, but in terms of speaking about the entire economy, it's not necessarily a bad thing that it becomes a bit more normal, if you know what I'm saying. So sorry for making you angry for those who were hoping for a super high valuation. Then I'm going to pause for a bit of breath and make some room for the first questions.
For those of you who were a bit like maybe you skipped a couple of intro minutes what we had, just also to mention, so we will have 2 Q&A parts of today's webinar. First one is now starting, and thank you so much, Wolter, for this really good kickstart of today's webinar. I really like what you said on the proactive element of the metrics. So now really the teams need to look at the metrics and present them more proactively, that the decisions are able to be made based on those. Okay, let us see on the questions, and we have the first one kicking in. What did you say the most commonly used valuation technique is in SaaS, and what is the formula?
E-PEF. It's not like you could, of course, it's I-PEV. That's how you write it. It's a common standard. You can Google it and look through a 20-page boring document. It's not really that straightforward as you type in your ARR and you type in a growth percentage and it comes up with a valuation. You have those websites as well, though. If you want to have a quick look, they're usually accurate to maybe like a 20% type of thing. But the EPEF is really the detailed one, the one you will end up negotiating with an investor. So it's hard to answer in a short minute here.
But we can always send an answers after the webinar.
Yeah.
So Jonathan, thank you so much for the question.
Just book some time with me. You have my email if correct from the webinar, so we can talk about it and can explain it in a bit more detail.
Indeed. Thank you, Jonathan. We have also one more question, Wolter, and multiplies for evaluation seems easy to understand and to talk about. However, we have been met with the wishes for DCF models in steady. What is your take on that for an early stage startup? We have no idea of, and now I will apologize if I say this wrongly, VACC cutoff value, etc. I think that you can
exactly.
also open it in the
Q&A. No, that sometimes happens. I would say make sure you speak to the right VCs there as well. A lot of those things come down to metrics that you would need to present that have something more to do with a scale-up phase. You need to present some revenue retention. You need to some lifetime value, which is not yet relevant in a startup phase. So if you're challenged by that, you can challenge those things back at them, to be honest. But again, this is like from what I hear and from this question, it's hard for me to picture like the actual discussion. So happy to grab a coffee and talk this out together. But I can imagine it's all negotiation, right? We're in it's a salesy life. Yeah, speaking with VC. So.
Super good discussion. We got also one more, Wolter, and thank you so much for the questions, of course, and to break down also a bit of a presentation with this discussion. It comes also good for everyone and also for Wolter to take a bit of a pause there. A few slides back, you said the revenue growth rate seemed less important. Is this reflecting also in valuation too?
Yes, I would say. I mean, it's reflected in valuation. I think it's still super good if you can present a super high revenue growth, but not at all expense. So if you compare the revenue growth, if you next to that have a super positive SaaS magic number, meaning your sales, spoiler alert, meaning your sales and marketing machine is very efficient, then it's super strong to still show that revenue growth, but it's not the part where we grow at all costs anymore. So I mean, that's what changed. So it's still super. I mean, if you grow 150%, you get a big high five, of course. But if you spend 5 million euros in cash to get that percentage up, and that's not weighing up against each other, it still might be not the most important thing to look at that time. So it's still super important if it goes hand in hand with the good capital efficiency ratio.
And our audience is on fire. We got one more, Wolter. I think that I will need a bit of your help with this one. And then we can also leave the rest of the questions for end of the webinar. So what is the most common capitalization ratio of RD, apologies, expenditures, if I said this correctly? Can you check?
Sorry, I didn't get that at all. Sorry, man. Can you repeat that?
Can I send it over? Maybe just like this. You can open it. Okay. What is the most common capitalization ratio of RD? And I'll need a bit of a help. My English here stopped. Just a moment. Let me do it like this. I will send it over in the chat. This also happens real time. R&D. Thank you, Jonathan. R&D.
Okay, if I see it here.
Thank you, everyone. Yeah, now when you have a live webinars, this is.
Yeah, exactly. This is the interaction we are looking for, right? I'm going to check if I can open something here in chat. Where's my mouse? There's my mouse. What is the most
research
common...
and depth?
Okay.
Thank you, Vila.
There you go. There you go. Sorry, the most common capitalization ratio of R&D. To be honest with you, I really don't know what the most common one is, but we are speaking a bit about how you can look at R&D in the next slides. So I think we'll get back to that, and if not, let's discuss it further. But I think we'll get to an answer there.
Great. Let's continue. Thank you, everyone, for jumping in. Much appreciated.
Super nice already. So many questions there. Maybe I'm a bit fake. That's the reason for those many questions. I don't know, but let's go. Good, thanks, Savoya. So we're gonna talk about the SaaS magic number next, but to understand the magic number, we first need to understand kind of the costs we are making to bring our customers in. And that's measured typically in SaaS companies by the customer acquisition cost. And that is kind of the sales and marketing expenses a company makes to bring in a customer. So that's typically expressed in like, okay, so if our monthly cost for the sales and marketing organization is 10,000 euros and we bring in one customer, then our customer acquisition cost is 10,000 euros. So it divides the total cost by the number of customers. And if you would have more customers, the customer acquisition ratio goes down. So that's the cost element of the SaaS magic number, which is really important and actually a super powerful metric on its own. and also is used to measure against what we talked upon earlier, the lifetime value a bit. So you can also see it like, okay, so if a customer sticks typically for 2.5 years and they pay €1,000 a month, then that's our lifetime value. How does that weigh up against the cost? And that's the 1-to-3 ratio I talked about a bit earlier. Super important metric. If you then look at the SaaS magic number, it's more of a popular metric for a good reason, actually. The SaaS magic number represents your sales and marketing efficiency, and it's ultimately kind of designed to answer the question, should I stop investing in my sales and marketing engine, or am I not grabbing my momentum? Because we're getting super fast return on investment from our sales and marketing efforts, and we could use market share, lose market share if we don't, invest more and pump more money into this machine. So how do you calculate this? Is you take the current quarterly revenue minus the previous quarterly revenue, which brings you your quarterly growth roughly. You multiply that difference by 4 to kind of annualize it, and the figure coming out of that is divided by the previous quarter sales and marketing cost, because the effort that the team made in that previous quarter is impacting the current revenue, right? So it's always a bit playing with the time there. This outcome brings us to an analysis we can then make. So if we then sum, if the outcome of the sum on the previous slide is greater than 1, it kind of means your sales and marketing machine operates very efficient. Always sounds like a super good thing, but this could also mean you're not grabbing the momentum, and it's time to scale the team and reach bigger. If investors will also use this metric to, judge funding requests a lot of the times. If it's between 0.5 and 1, it needs some efficiency improvements here and there, or it can mean you are investing, or you just recently did investments. Because the investments you make, if it's between that, it means that it takes longer than 1 year to win back that money, and that's not always perfect, right? We want money back from our investment soon. So it's good to revisit strategy. And if it's below 0.5, it would be really wise to revisit the full strategy. Are you focusing on the right ICP, ideal customer profile? Is your pricing correct? But investing would not be a smart idea at this stage. So the SaaS magic number is not so magic that it's bulletproof and the only metric you need to look at. It's an efficiency of measurement of sales and marketing. It does not speak about profitability or margin at all. Some companies have a bit of a longer sales cycle, so there could also be a delay in results that you measure. And make sure to think about this as a reason why it could be lower, right? As well, especially now that we're in economical, wow, difficult word, drift. It is imperative actually to measure this constantly to see when momentum is there, so you can jump on that. And if not, keep your cash in your pocket. Because spending cash wisely, like I said, capital efficiency, this is kind of a big part of that little thing. So I hope that's a bit clear. Then going into another very high requested metric actually of today is the average revenue per account, the ARPA. ARPA, for those who don't know, it's kind of the ARPU equivalent of the B2C world. You also see ARPU in SaaS, though, if you have a lot of revenue on a user level. That's what the U stands for. ARPA is important not only to look at in a total customer perspective. So you can see here in the screenshot, this is all our customers in Younium, like how much, this is not our actual Younium, it's the product and a demo environment. But what is the total average CMR, the contracted monthly recurring revenue on our customer base, and how is it evolving over time? And that is super important if you're targeting specific countries, if you're targeting specific industries as well, because if you have a low ARPA in a certain country, it could be that sales spends a lot of time in negotiation with contracts, because simply the pricing should be a bit lower in those countries. So it tells you about your pricing strategy, and if you have a better price, you decrease the sales cycles, which gives you money on the bank faster. So, or if simply an industry performs better, you can focus your effort closer on those industries. And if your magic number is also positive, you can make some investments in that industry as well, like hire specific enterprise account executives for a certain, segment or whatever. So it's a super important metric, not only to look at from a holistic point of view, but really in like, how is it in segments? How is it in countries? Those could really help you out next year determining, am I doing the right things? So make sure you check that out. Also another, MR, I think everyone, we skipped the basic MR and AR for this presentation, and we kind of assumed everyone knows this. But we also want to advise you to look at product performance based on MR. And therefore you look at MR in both product, but also product categories. So MR per product basically means looking at each product line that you put on an invoice to see where your revenue comes from. If you use product hierarchies, like we do at Younium, you can, for instance, learn a lot from them too. But you probably have a core service like your basic, premium, and enterprise edition, and that you want to learn from, like, how is my MR performing in that specific bundle, or things like that. Product managers should look at this every now and then, because when features are released, you can see, okay, how are my core services performing? So we at Younium, for instance, have our core platform fee. Then you have maybe a setup fee, which is not recurring revenue. And then you have, for instance, add-ons or connectors or integrations. And I think a lot of you will recognize those kind of pricing models. So it's not only good to see it on a line-based level, but also on, on the add-ons, on the core services in addition to that, because that can make you decide, am I growing? So you have a roadmap, right, in your product management team. Am I developing the right products? Because my MRR growth is only on add-ons, it's not on the core platform. Is that correct? Am I also developing only according to that? Or should I maybe develop more things like the add-ons, because we can monetize on that? So take your MRR measuring to the next level, and don't show the consolidated version, but really dive deep next year. That's going to help you, again, with capital efficiency, because you spend your money not only in sales and marketing, but also in development very efficiently. Good. Then SaaS businesses are typically growth-oriented businesses, but we're not always good to realize we can also grow some revenue on the existing customers, right? So they already know your value. So in a recurring business, your existing customers are feeding your business already. But let's not forget that customer success organizations are not cost departments, they're revenue departments in the SaaS world, right? So during economic decline, it may be extra hard to speak to new prospects that haven't experienced the full value of your product firsthand and are reluctant to spend money at this stage. But I'm sure all people here know their SaaS solution brings ROI to their customers, but your prospects still have other decisions to weigh against and between your tool and other tools that bring ROI. Or they simply want to see what the economy does first before buying anything else. Actually, I heard something really interesting, is like the biggest competitor in SaaS is not your actual competitor, it might be status quo. So it's super interesting to think about. People just want to stay where they are. That might be the biggest competitor. So look at how you can break that. But luckily, there's a pool of prospects that already is in your customer base, and there's many reasons to speak with them. I only put a few here because my marketing colleagues told me to keep the slides clean. But it could be so that an initial deal stage considered out of the bare minimum deal package due to budget constraints. The customers probably already reached ROI with your platform and their investments a long time ago, so they'd be happy to spend a bit more money because they know that you got their backs pretty much. They have maybe changed their IT landscape since the first talk and the first deal. So maybe there's an integration you can sell. Maybe there's something else, an add-on that will suit their new landscape better. And maybe you have any new monetized features that you have released, and it's good to speak to them as well. We track this success typically by measuring financial bookings like upsell, CMR, or churn. But to have a direct overview, to see how you are performing with your existing base, it's actually best to look at net retention. And the net retention is the percentage retained of the initial contract value affected by changes to the subscriptions, such as upsells, downsells, churn. Normally, what you can see here on the slide is that it's visualized vertically. It's normally visualized horizontally, but the same principle applies. So we closed one customer of €1,000 MRR in January. So that's where our net retention starts. Our net revenue retention starts at 100%. In February, we then closed an upsell on this customer of €500 because a nice little add-on was sold. And the €500 is half the original revenue, so it increases with 50%, bringing our net revenue retention to 150%. In March, however, the customers decided to cancel a few users worth €250, bringing it to 125 of the original signed revenue. And in April, they canceled. Normally, this is spread out a bit over time, but just to show you how this, is measured. And I think for startup companies in this webinar, I can imagine this is not super useful. Like we also had the question earlier. I mean, you will not have a lot of net revenue retention yet if you just started and your first customers are live 2 weeks. I mean, I hope everything is still 100 or higher. So if you're in the startup phase, it's good to look at kind of, yeah, I don't know if that's a term, but the product retention. What things are they looking at? How are they using your product? What features are they clicking? How often are they logging into your solution? Is it something that has become sticky in their daily lives? Can they not live without you anymore? Track the user retention. Not sure if that's a metric, but a free one for me. So the net retention, to summarize what it means over your whole subscription stack, if you have a net retention below 100, then we need to chase the sales teams, to compensate for the lost growth over time. And we will need to rely on sales to, bring in so many new deals, because at the back door, they're all going out again at some point. But if we're on 125%, we have a growth in our customer base that new sales can just be considered as new sales. It's just, happy new extra customers, extra revenue. So having a good and healthy net retention is super important to measure. I think in average, SaaS companies are on 100, looking on the global level, but it's of course good to be higher than that. Wow, I've been speaking for such a long time. This is the last one before I shut up again. Before I talk about what this North Star is, I would like actually to ask the audience. So you have the chat and then you can select like who are you chatting to the panelists or to everyone. Make sure you type to everyone and drop a 1 in the chat if you have a North Star metric that you're measuring. Because I'm quite curious to see how this is used already or is it not used at all. So please put a 1 in if you're measuring this at the moment. Because going into next year, this may just be the most crucial metric yet, even though your management team or a VC might not ask, like, how is your North Star doing? I don't know, could be. This metric should visualize kind of the goal that contributes to all other goals you have. Sound hard, right? Few examples like Facebook that has a certain number of monthly active users they want to measure. Active users means learning from the platform, means good advertisement performance, means good revenue, and so on, right? So this one little thing triggers 10 different things behind that. And Spotify, for instance, measures the time spent listening to songs. Happy listeners don't mind paying for their subscriptions and don't want to cancel. So, just they measure the time spent listening to songs. I think that's really, really good. There's many more examples. It is, however, good to put some structure around it. So the North Star is used by all departments in the company. So everyone should feel they can contribute to it. It is not a metric that you want to see results from next week. So it's a long-term kind of metric. And again, bringing up the economic decline, it is imperative that you and your teams are all working on the same goal and on the same journey. This metric could actually be that goal. And it can also, in worst case, make people understand, if you need to restructure why they're being let go, because, we're not meeting this like the ultimate goal. It's just not happening. And if they buy into this metric early on, the chances of having a good eNPS rate greatly increases as well. So the employee net promoter score, right? This is kind of the final recommendation to start measuring. There's not much of a framework around one, but it's super important. I love it if people have this, so hoping that a lot of you do or get inspired to start doing this. It's a great way to align your organization.
While we wait, Wolter, for our audience to drop us, do they have their North Star of the metrics, what they track? I will just use this opportunity to give a bit of a disclaimer. I think under my name there is magic, but it's not that I'm from marketing, so it's not that I'm that big fan of SaaS magic number. It's actually my last name I'm from Croatia, so my last name is Magic, and it's spelled as magic. So it's not that I put it there, and that's also probably where I have a bit of a challenge when I say something on this finance terms. So thank you everyone who helped out a couple of minutes before when we had the first Q&A part. Okay, let us deep dive into the chat exercise. So what does this mean? Before the webinar, we invited you, if you can send us over your metrics that you would like to hear more about. A couple of those Wolter already added in. We also saw how they look in the product environment. So for example, in Younium, where you can see them. So that was really nice, especially with the ARPA slide there a couple of minutes before. But if there is any specific SaaS metric you would like to know more about, send us that in the chat, or send it directly to the panelist, and we will send you a 3-minute explanation video of this SaaS metric, including some nice tips, how you can get it and how also you can present the data. So please drop over which metric would you like us that we deep dive into more, and then Wolter, our subject matter expert, will send you over a video of like a 3-minute video where we will deep dive into this metric for you, and also to show you and to give you some tips and how you can present it.
Great. Yeah, looking forward to do that, and looking forward to see what you want. So to conclude kind of the content portion of it all, spend money wisely and focus on the things that bring value now. So, make sure that the cash is there and spend it efficiently. That is going to do probably the most important thing for next year. That is backed up, of course, by delivering on the things that impact you in each market and segment. And you do that by measuring the MRR on product line level and on product category level, and measuring the ARPA in specific segments and countries to make sure you're investing your roadmap resources on the right place. Of course, don't forget about your existing customers. You actually see, if you can Google that, there's a lot of research that currently SaaS companies grow harder than ever on their existing base, because those are the ones that understand your value, and where sales might be a bit more tricky, CS brings in closes the gap. So make sure you focus on that and think of extensive programs to keep the business going next year. The North Star, it's a clear, outspoken and measurable vision to go after together with your team, which I really like. Any questions?
We got a couple already, Wolter, and thanks for everyone. Really, audience is on fire on this webinar. But before we deep dive into the questions, let us just take 1 minute also to introduce the Younium for those of you who are first time with us. We have a couple of people joining us for several times, so thank you so much on that, and also welcome to everyone who first time joined the Younium webinar. So we are a SaaS company founded in 2017, currently having offices in Netherlands, Sweden, and United States. And Younium is a specialized subscription management platform for SaaS companies. That is what we are niched, and that is where we bring the most value. If you would like to know more about Younium, and also how can Younium as a platform and as a solution help you out with your metrics, feel free to reach out to us, we will show you the platform and also what it can do in your future business growth, and how you can manage your metrics. And also this, what Wolter said, the platform supports you also in the customer retention, that there is a couple of really good features what you can look into the revenue leakage. But let me now go over to the Q&A part, Wolter. There are really a couple of good questions. Some of them are really also connected to the SaaS magic number. Now, one of those questions is, should we be using income or ARR when it comes to the SaaS magic number?
What was the first one?
For the SaaS magic number, should we be using income or ARR?
I think most companies do ARR. We at Younium do ACV, because that also includes the value of, like, if you give, for instance, a first-year contract, first-year discounts. We sometimes do that, and an ACV looks beyond kind of any temporary agreement. So it shows a bit more on the actual value you're signing. So if you give 50% off on the first year, the actual ACV is 50% higher than the ARR. So that could say something. It depends. We do ACV. I think most companies do ARR. What you want. I think ACV is better, as you work with temporary discounts and ramp-up deals.
And when it comes to the good upsell percentage to having SaaS, what will be then a recommendation?
I mean, the average net retention, good is 100% is like good, but I don't think most people here settle for good. So if you have 100% net retention, then you're good, but you don't want to be good, you want to be great. So I think 10% upsell, 20, sorry, no, that's not it. So you need more upsell to also cover for churn. So I think you should aim for a net retention of above 110%. That's what the great companies do.
And there is also a backup question or follow-up question on the SaaS magic number, what we had as a first question in this second part. When comparing it to the sales and marketing cost, how does it then go?
When comparing it to the sales and marketing cost, you mean the SaaS magic number?
Yes, and should we be using income or ARR?
Also ACV. I do ACV. Yeah. In my opinion, I mean, it depends. If you work, so ARR, that's the thing is it's real-time measurement. So if you sign a customer today on what is it, the 1st of November, and the start date of the contract is January, that means that my today, but my ACV is, because that's on the booking level, that's on the date it's actually signed. So if you have longer sales cycles, it is, you have a better view if you look on an annual contract value, because that's on the date where you actually sign the agreement. So the revenue is sooner, not the actual money you can spend, but the contracted revenue is sooner. So for us internally, and for those that have a bit more of a longer sales cycle in general, I think it's better to look at the ACV. If you have a model where a customer can sign up on your subscription today and start using it, and they also from that point on just immediately are revenue based, so they can sign up on the 12th of January, and also you invoice on the 12th of January, AR is fine, and you don't work with temporary discounts.
Thank you, and thank you so much for the questions. We have a couple of more lined up, Wolter. Again, connected to the SaaS magic number, do we use only recurring revenue?
Tricky. I think for real SaaS businesses, that whereas a revenue, I mean, typically you have maybe a setup fee or something like that, it's not commonly included in, because the setup fees are and the one-off fees are typically made to cover for the cover for your onboarding time, cover for your resources. So it's not really revenue, it's more of a close the cost gap than anything else. So we don't include it, and I think most people don't include the one-time revenue.
There is also one more question that's related to CAC. Do you calculate CAC quarterly, monthly, or yearly? And this is only for the new business, not expansion. Do you include both new business and expansion in calculating, again, this really good metric, SaaS magic number?
I love it. This is a super good question, a super hot topic. So typically CAC covers the sales and marketing costs, and sales and marketing are typically, unfortunately, not always the ones that speak with the existing customer base. So marketing in many businesses is real focused on like getting brand awareness, getting the existing, getting new customers into the door. Whereas, you know, customer-based marketing is super important, and it's luckily being much more of a trend lately in SaaS world. So I think, I don't know if it exists, to be completely honest, but I think it would be super good to include your customer success manager as your sales, and any marketing efforts you spend on your existing customer base. If you make a separate customer acquisition cost for that, an upsell cost, if you will, and measure that against the added revenue, I think that is super good. I don't know if there's a formal metric. I have not heard about it yet, but I think it would be super wise to measure.
Well done. Thank you everyone for the really good questions, and also it was good that we reserved this 15 minutes, because the chat box and also the Q&A part are on fire. So Wolter, be ready. We have a couple of more lined up there. One is connected actually to Younium. Do you have AAPs common ERP systems?
Do you have, sorry?
Do you have APAs to common ERP systems?
Yes. Yeah, so if you go to our lovely marketing team, make sure that we cover that. So if you go to our website, younium.com, we have a section on connectors and API. You can see all the connectors that are listed, but I think every kind of local country's ERP system there, and kind of the more global oriented ones like a NetSuite or Microsoft BC is there as well. So, but check it out on the website. If it's not, let's talk.
There is also a question on one of the slides where we saw also the Younium product and how does it show on ARPA slide. Do you measure CMRR, and can you elaborate more on that metric against the MRR?
Yes, that is a good question. So the MR is like, we kind of touched upon it on a question earlier, but MR is like, I sign a contract today, it's the 1st of December, but my contract, the customer with the contract, the customer's contract starts on January 1st. So that's when they start paying 100 euros a month, right? So my CMR is the contracted value of this customer. So let's say we didn't give any complicated discounts or whatever. So my CMR is going to be today. I got my contract signed. So I have committed contracted monthly recurring revenue for this customer on 100 euros. But if you speak to your CFO, they say, no, I get 100 euros in January. But sales says, no, but I got my deal today. I got 100 euros now. And the CMR is the metric that kind of bridges the ramp up time and bridges those kind of things. So the CMR looks beyond any like time in that sense. So the 100 euros is going to be the contracted value from the point of signature until another booking happens. And a booking is, for instance, an upsell. So if it's 20 euros, then we have a CMR, a total CMR of 120 euros, but that specific booking is 20 euros CMR. It looks at, the actual contracted value past any temporary agreements. Like, for instance, if you give a first year discount of 50% on a 100-year contract, the MR will be the first year for every month, 50 euros, 50 euros, 50 euros. But CMR will directly be 100 euros because it looks at the contracted value past any temporary. That's it in a nutshell. But we have a blog, CMR versus MR, on our website in the blog section. So make sure you check that out as well. And I think 3-4 webinars ago, we also talked about this. So you can check that out on YouTube.
Yeah, or just reach out to us and then we will send you over, drop an email to Wolter and we will send you all of the materials, what we have. And Linda will also now share a guidebook in our chat box. But before all of that, or that's now happening in real time, let's deep dive into one more question. And this one goes, cost of goods sold in SaaS companies are difficult to define. What is your best definition? And how do you get a fair gross margin?
It is indeed. I think it's okay to define. It really depends on kind of what business model you have. The only thing I could really stress here is like, once you set this up, don't touch it. So if you change your cost of goods sold, like, okay, we include our the time the pre-sales engineer spent on doing demos, and then the month after that, you don't include him or her anymore, then you're going to get fluctuations in the cost of goods sold because you just measure it differently. And if you then start weighing it against the results, it's going to not be any good metric anymore. So I think, cost of goods sold or customer acquisition cost, whatever you want to call it, I think it's just very good to stick with something that you have thought in January that is best and don't change it for that year at least. I think that's the only thing I could say about that.
Thank you. And we have 2 more questions, Wolter. Are you ready for those?
Yes.
Yeah. Thank you so much, everyone, for the engagement. We really much appreciate that. And this is something that we were looking for with this webinar, to have a more in-depth discussion. And I also learned a couple of things I will need to repeat on the pronunciations part. But okay, this one is kind of easy. Does Younium themselves include things like a customer dinners in the CAC?
We internally.
Yeah.
So I don't know if we used to do it prior to COVID, to be honest, but for sure we don't include it anymore because it happens very rarely. I think most of our internal meetings take place online. So, I mean, I can pay for my own lunch here. So we don't do that internally, if that's the question. No.
And there is one question about the metrics and Younium and platform. So for me in marketing, kind of everything is easy. I go to Google Analytics and I see there everything is calculated. But in one moment when you did those calculations, I'm sure that people in finance know much better than I do. It looked like, wow, this is a kind of interesting formulas there. So the question goes, does Younium provide all of these metrics in the platform?
Yeah, so I would say most of the revenues, the metrics, I mean, all the graphs you saw today were actually Younium product graphs. So I think a lot of it is in there. We do cheat a bit on the cost side. So we're a subscription management platform for customer subscriptions, right? So we're optimists. We only deal with incoming revenue, not as much with costs. But what we did is we kind of have a bit of a workaround where you are able to put in costs as a passive kind of metric. So for instance, Younium has support customer acquisition cost, but we don't know, the cost of your actual sales and marketing efforts. So that needs to be fed from a finance system to Younium. So kind of, if you think on the revenue metrics, I think we have most, or I think we have all, at least most that we covered today. If you think in costs, then not as much, but we have cheaty workarounds, if that's English.
Nice. Yeah. Thank you. We have a couple of questions what came into the chat, but we will take those as a video, reach out. So one is connected. How do you define an active user? Maybe if you would like to take it now, Wolter.
Active user, it's usually a product kind of thing. So active users are typical. So for instance, you see this a lot in expense management SaaS products. So where you can, take a picture of your receipt and then, send it in for like that you get your money back, expense claim it. And there you have, like, if you have a company of 200 employees, but maybe as an example, 50 people are working in the warehouse, they don't go out for customer dinners, but you also want to give them the app to make sure that everyone in the organization uses it, but they may use it once a year, and whereas sales may use it 10 times a day. That's when a lot of companies work with active users. And active users are then, you pay a certain fee for all the users, but you only pay for the ones that are actively using the product. And that in Younium, I think it's related to the metrics, we use it as usage-based metrics. So for instance, you can have committed users. So a customer signs up for 50 users, they're going to commit to use, and they pay an upfront fee for that. And they can overuse, for instance, the warehouse employees. They could, for instance, have 2 or 3 expense claims, and then you pay €5 per user. And that is usually measured in the committed revenue for the users is just MRR, right? That is pre-agreed money. And the usage is then added to like the retroactive MRR measurements, but can also be, for instance, estimated monthly recurring revenue. Another time where I will refer you to our blog post, we have the EMR metrics part 3 blog, I think, top of my head, it's called, where we talk about this in detail, because I think 80% of our customers run this. It's super common in SaaS.
Thank you so much. And thank you everyone for the great questions. We are 2 minutes over time. We got a couple of good questions in the chat, and Wolter will send you over a 3-minute video explanation how you can get those metrics, how on some of the tips, how you can also measure them, where you can see them. Thank you everyone for joining us for this really good webinar. And what else to say? We were going to send you over the recording in a couple of days. Linda will also send you the guidebook. Also, the presentation will be sent over to everyone. Thank you so much for joining us. Thank you all for the great support when I had a bit of a challenge with the pronunciations. And yeah, I think it's December and we're entering the holiday season. So we wish you all nice holidays as well.
Happy holidays, and thank you so much.
Thank you. Bye.